For 50 years, silver was told where it belonged, under $50, never higher, never free. Every breakout failed. Every rally was crushed. Every believer was proven wrong. Until now, because something has changed. Not sentiment, not speculation, but structure. Prices collapsed from 90. Fear flooded the market. Headlines screamed the end. Yet behind the noise, someone was buying. Quietly, relentlessly, strategically. Nations, not traders. Vaults, not screens at metal, not promises. The charts are no longer suggesting a move. They are demanding one. And the number they point to is not 50, not 100. It's 300 by summer 2026. But the reason why is not where most people are looking. And once it's seen, it cannot be unseen. Welcome to Boring Currency Ledger. If you have lived long enough to remember when money carried weight, not just numbers on a screen, then you already understand why this conversation matters. Before going further, subscribe to this channel the way one would ask an old trusted friend to stay for the full discussion. Because what follows is not repeated in headlines. And tell us, from where in the world are you watching today? For most of modern financial history, silver has been treated as a solved equation. Analysts classified it as an industrial input with limited upside. Traders viewed it as volatile and unreliable, and policymakers largely ignored it altogether. In textbooks, it appeared as a secondary metal, useful but not decisive. In capital allocation meetings, it was rarely a serious topic. And in portfolios, it was often treated as an optional hedge rather than a strategic asset. That assumption held for decades. But assumptions only survive as long as reality allows them to. Silver spent nearly 50 years confined within a narrow price range. From the early 1980s through the mid-2020s, it repeatedly failed at the same upper boundary. Each attempt to rise above that level ended the same way. Sharp reversals, heavy selling, and a return to what markets considered normal. Over time, this behavior trained participants to believe that silver simply could not escape its historical limits. The ceiling became accepted as a law rather than a condition. Yet during those same decades, almost every other major commodity rewrote its price history. Gold exceeded its previous highs and continued to reprice upward as monetary conditions shifted. Copper broke out of its long-term range and adjusted to global industrial expansion. Energy markets experienced repeated repricing cycles driven by supply stress and geopolitics. Even agricultural commodities adjusted as global demand evolved. Silver alone remained frozen, disconnected from the broader trend. This divergence reveals the anomaly. In efficient markets, prolonged underperformance is usually explained by weak demand, abundant supply, or declining relevance. Silver fits none of these explanations. Its industrial importance has expanded, not shrunk. Its monetary history spans thousands of years. Its supply growth has failed to keep pace with usage. The contradiction is structural, not cyclical. Financial systems often mistake suppression for stability. Long periods of low volatility are interpreted as equilibrium when they frequently reflect distortion. In silver's case, repeated rejection conditioned the market to dismiss upside risk. Capital flowed elsewhere. Models were built assuming the ceiling would always hold. Price discovery became shaped by expectation rather than fundamentals. But markets are not governed by belief, they are governed by imbalance. When price no longer reflects underlying reality, pressure accumulates quietly. That pressure does not release gradually. It releases suddenly, often when confidence is highest and attention is elsewhere. History shows that assets held below their natural valuation do not adjust politely. They reprice decisively. By the mid-2020s, silver's behavior began to change. Corrections became sharper but shorter. Breakdowns failed to restore the old range. What once acted as resistance began functioning as support. These shifts were not noise, they were signals. Such signals indicate a regime change. Old reference points lose authority. Traditional indicators struggle. Volatility expands, not because of chaos, but because constraint has ended. Silver is no longer negotiating its place within an old framework. It is responding to decades of delayed adjustment. This is why recent price action cannot be evaluated in isolation. The correct context is not months or years, but half a century. When markets correct long-term distortion, outcomes are not incremental. They are proportional to the delay. The critical question is no longer whether silver can move dramatically higher. The real question is why it remained compressed for so long. Because once that question is understood, urgency replaces doubt. Markets have a memory, even when participants forget. Prices record stress, suppression, and delay in ways that are not visible in headlines, but are preserved in long-term structures. Silver's history is not a story of failure to rise. It is a record of sustained compression, an economic condition that rarely ends quietly. Compression occurs when price is prevented from adjusting to changing fundamentals over long periods. This can happen through regulation, market structure, substitution effects, or entrenched expectations. In silver's case, it was reinforced by all four. Over decades, repeated reversals taught investors to expect rejection at the same levels. That expectation became self-reinforcing. Selling increased near the ceiling, volatility collapsed, and price appeared stable. But stability created by suppression is not balance, it is tension. In physical terms, compression stores energy. In markets, it stores volatility. The longer the compression lasts, the more violent the release tends to be. This principle is observable across asset classes. When currencies are pegged too long, they eventually break. When interest rates are held artificially low for extended periods, distortions build across capital markets. When commodities are capped, despite rising demand, repricing becomes inevitable. Silver's compression phase lasted nearly 50 years. That duration is not incidental. It places silver among the most prolonged cases of price containment in modern commodity history. During this time, global demand changed, industrial usage expanded, and monetary conditions deteriorated. Yet price failed to respond proportionally. Each year of inaction increased the divergence between market value and real-world utility. Economic models often underestimate the impact of time. They focus on supply and demand snapshots, not accumulated distortion. But markets resolve imbalance cumulatively, not incrementally. Every year of mispricing adds to the eventual adjustment. Historical precedents make this clear. Copper remained trapped in a narrow band for decades until global infrastructure expansion forced a repricing. Energy markets experienced similar compression during periods of artificial oversupply before geopolitical constraints triggered sharp revaluations. Even gold, after long stagnation, entered rapid expansion phases once monetary credibility weakened. In each case, the release was not gradual. It occurred in concentrated bursts. Silver fits this pattern precisely, but with one critical difference. Its compression period is longer than most, which implies a larger adjustment once release begins. During extended compression, volatility does not disappear. It relocates. Instead of expressing itself through price, it builds internally through inventory stress, supply chain fragility, and capital misallocation. These pressures remain invisible until a trigger forces price to respond. When that happens, historical reference points lose relevance. This is why long-term charts matter more than short-term indicators. They reveal whether an asset has been allowed to express value freely or has been constrained by repeated intervention. In silver's case, long-term charts show a flat structure where growth should have occurred. This flatness is not evidence of stability. It is evidence of delay. The critical moment in any compression cycle is the breach. Once price exits a range that is held for decades, the psychology of the market changes instantly. Sellers who relied on historical ceilings lose confidence. Buyers who were previously cautious begin to act with urgency. Liquidity thins as participants reassess risk. Price becomes less sensitive to traditional resistance levels. This transition is uncomfortable to observe. Corrections become sharp. Moves appear erratic. Commentators describe the market as unstable, but instability is often the sign that artificial order has ended. Silver's recent behavior aligns with this pattern. Price no longer responds predictably to former resistance. Pullbacks fail to restore the old range. Each attempt to suppress price results in shorter recoveries and higher subsequent lows. These are textbook signals of compression release. Importantly, this does not require speculation or mania. It requires only the removal of constraints. Once price is allowed to reflect accumulated imbalance, movement becomes mechanical rather than emotional. This is why the largest repricing events often surprise even experienced investors. They mistake long calm periods for permanent conditions. For business leaders and capital allocators, understanding compression is essential. Assets emerging from long suppression do not offer linear opportunities, they offer asymmetric ones. Risk shifts from volatility to absence of exposure. The danger is not short-term fluctuation, but long-term exclusion from repricing. Silver's compression cycle suggests that the market is no longer deciding whether adjustment should occur. It is deciding how fast. And when compression finally resolves, it rarely does so in stages. It resolves in sequences, sudden, forceful, and indifferent to disbelief. The question facing the market now is not whether silver will revert to its historical range. It is whether that range ever represented reality at all. When markets emerge from long compression, they do not move the way textbooks predict. They do not climb steadily, allowing participants time to adjust. They accelerate. Speed becomes the defining feature. This is not driven by excitement or narrative, but by structure. Once delayed repricing begins, time itself becomes compressed. Silver's historical behavior during expansion phases reveals a consistent pattern. Major advances do not unfold over years. They occur in months. Long periods of inactivity are followed by short windows where most of the total gain is realized. Outside these windows, progress appears modest. Inside them, price advances rapidly, often faster than participants believe possible. This pattern has repeated across cycles. Silver first establishes momentum, then experiences a sharp and unsettling correction. That correction serves a purpose. It removes participants who are positioned without conviction and reinforces the belief that the move has failed. Only after this shakeout does the true expansion phase begin. This structure matters because most investors respond to confirmation, not probability. They wait for stability, clarity, and reassurance. In compression release markets, those signals arrive late. By the time confidence returns, price has already adjusted. Timing windows exist because capital repositioning is not evenly distributed. When long-held assumptions break, decision-makers do not act simultaneously. Some respond early, based on structure. Others react later, based on headlines. This staggered response creates bursts of demand over short periods, pushing price rapidly higher. In silver's case, this effect is magnified by years of neglect. Capital exposure to silver has been minimal relative to its role in global systems. When even small reallocations occur, they have outsized impact. The market is not deep enough to absorb sudden interest without price adjustment. Volatility during this phase is often misunderstood. Sharp declines are interpreted as failure when they are actually structural resets. They clear excess leverage, reprice risk, and strengthen the foundation for the next move. In historical silver expansions, these corrections occurred mid-cycle, not at the end. Technical indicators struggle in such environments. Tools designed to operate within stable ranges produce misleading signals once regimes shift. Overbought readings appear early. Momentum metrics exceed historical norms. Analysts conclude that price has moved too far, too fast. But these conclusions rely on reference points that no longer apply. This is a common failure during regime transitions. Indicators do not adjust immediately to new realities. They lag, anchored to historical behavior. Participants who rely on them often exit too early, expecting mean reversion that never arrives. Timing windows are therefore not predictions. They are consequences of structure. Once a compression cycle resolves, the release phase follows a rhythm shaped by capital flow, liquidity constraints, and psychological resistance. These factors converge to create limited periods where repricing occurs at scale. For silver, the current structure suggests that such a window may already be forming. The initial breakout established direction, the correction tested conviction. What follows historically is acceleration, not indefinitely, but within a defined span. This does not imply a smooth ascent. Fluctuations remain violent, confidence remains fragile, but direction becomes persistent. Each pullback fails to invalidate the broader move. Instead, it reinforces the underlying shift. The importance of timing lies not in precision, but in awareness. Markets do not announce when windows open. They reveal it through behavior. Speed increases, resistance weakens, corrections shorten. Price spends less time consolidating and more time advancing. For decision makers, the risk is not entering too early. It is assuming that time remains abundant. In compression release cycles, time is scarce precisely when clarity appears. Silver's timing window is shaped by decades of delay. The longer repricing was postponed, the narrower the window becomes once it begins. This is why major historical moves often feel sudden in hindsight. Participants did not miss them because they were invisible. They missed them because they expected more time. As the structure continues to evolve, the question is not whether volatility will persist. It will. The question is whether the market is already within the phase where hesitation carries greater cost than action. Timing windows close the same way they open, quietly at first, and then all at once. Financial markets often speak in abstractions. Prices appear as numbers on screens, disconnected from the materials they represent. But when stress builds beneath the surface, the physical market begins to communicate in ways that paper markets cannot conceal. For silver, that communication has become increasingly difficult to ignore. There are two silver markets operating at the same time. One is financial, built on contracts, futures, and derivatives. The other is physical, governed by extraction, refining, transportation, and delivery. Under normal conditions, these two remain closely aligned. When they diverge, it is not an error. It is a warning. Physical markets do not respond to sentiment. They respond to availability. In recent periods, regional price differences have widened beyond historical norms. Silver priced in consuming regions has traded meaningfully above benchmark financial prices. Such gaps do not emerge from speculation. They emerge when supply cannot meet immediate demand. Buyers are willing to pay more, not because they expect future gains, but because they need metal now. This distinction matters. Futures markets can create the appearance of abundance through paper claims. Physical markets cannot. Every ounce demanded must exist, be refined, and be delivered. When physical premiums rise, they reflect constraints that no financial instrument can resolve. Supply concentration has intensified this effect. A significant portion of refined silver production now originates from a limited number of regions. When export restrictions, logistical bottlenecks, or policy shifts occur, the impact is immediate. Metal becomes trapped within borders. International supply chains tighten. Local scarcity develops, even if global production figures appear unchanged. These constraints rarely receive attention because they unfold quietly. There are no dramatic announcements, no sudden shutdowns. Instead, dealers adjust terms. Delivery times extend, discounts disappear, premiums widen. These microsignals accumulate long before price adjusts. Dealer behavior is one of the most reliable early indicators of physical stress. Dealers operate at the intersection of supply and demand. When they begin warning clients about delays or pricing discrepancies, it indicates that sourcing metal has become difficult. These warnings are not marketing tactics. They are risk management responses. Historically, such conditions precede price realignment. Paper prices eventually rise to meet physical reality, not the other way around. This pattern has repeated across commodities and currencies alike. When divergence becomes too wide, arbitrage forces correction. But correction requires time, and during that time, physical buyers bear the cost. Silver's physical signals suggest that the market is already tighter than financial pricing implies. Inventories are not replenishing as easily. Recycling flows cannot compensate for increased industrial usage. New supply faces long development timelines. These factors are structural, not cyclical. It is important to distinguish between scarcity and shortage. Scarcity does not mean absence, it means constraint. The metal exists, but not in the quantities, locations, or forms required. Scarcity increases sensitivity. Small increases in demand produce large pricing responses. Physical markets also reveal priority. When supply tightens, metal flows first to the highest value uses. Industrial applications with strategic importance secure access. Investment demand becomes secondary. This reordering creates additional pressure on available supply, particularly for retail and institutional buyers. Paper markets often fail to reflect this hierarchy. Contracts can be written without regard for delivery feasibility. As long as settlement remains financial, stress remains hidden. But when delivery is required, divergence becomes visible. Silver's role in modern infrastructure ensures that physical demand is not discretionary. Electronics, energy systems, and medical technologies do not pause because price rises. They absorb cost. This makes physical demand inelastic in critical sectors, further tightening availability. When physical markets tighten, price discovery migrates. It no longer occurs on exchanges alone. It occurs through premiums, delays, and allocation decisions. These signals are less visible but more truthful. For business leaders, ignoring physical indicators is a costly mistake. Financial prices reflect expectations. Physical prices reflect reality. When the two disagree persistently, reality eventually prevails. Silver's physical market is signaling stress consistent with early-stage repricing, not panic, not collapse, constraint. And constraint, sustained over time, has only one resolution. Price adjusts, not to speculation, but to availability. Demand is rarely a single force. In most markets, it arrives from one direction at a time. When multiple demand streams converge simultaneously, price behavior changes fundamentally. Silver is entering such a phase, not because of enthusiasm or narrative, but because its role in the global system is expanding on two separate fronts at once. The first demand stream is industrial, and it is structural rather than cyclical. Silver is not consumed in large, visible quantities like oil or copper. It is used in small amounts, embedded deep within modern technology. This makes its importance easy to underestimate and its depletion easy to overlook. Silver's industrial use has expanded quietly for years. It is essential in electronics, data infrastructure, medical devices, and advanced energy systems. Each unit consumed is effectively removed from circulation. The metal is dispersed in quantities too small to recover economically. Unlike base metals, it does not return to the market through recycling at scale. This creates a one-way flow. Industrial demand does not respond to price in the short term. Manufacturers cannot redesign systems quickly. Substitutes often compromise performance or reliability. As a result, higher prices do not reduce consumption immediately. They simply increase cost. Over time, this creates cumulative pressure. Annual deficits compound. Inventories decline gradually. Supply shortfalls are masked until they reach critical levels. By the time scarcity becomes visible, adjustment options are limited. The second demand stream is monetary, and its implications are broader. Silver has functioned as money for most of recorded history. Long before modern banking systems, it served as a unit of account, store value, and medium of exchange. Its monetary role did not disappear. It was sidelined. Modern financial systems prioritized credit over metal. Trust replaced tangibility. For decades, this arrangement functioned because confidence remained intact. But confidence is not permanent. It is contingent on stability. When confidence weakens, monetary demand reemerges. Investors, institutions, and populations begin to reassess what qualifies as reliable value. Gold has traditionally absorbed this shift first. Silver follows, often later and faster. What makes the current environment distinct is that silver's monetary role is being reactivated formally, not just psychologically. Regulatory recognition of silver as collateral changes its status. It signals acceptance within financial systems, not just at their margins. Monetary demand behaves differently than industrial demand. It is reflexive. As price rises, interest increases. As interest increases, participation expands. This feedback loop can accelerate rapidly once it begins. Unlike industrial demand, which is tied to production cycles, monetary demand is tied to perception and trust. When these two demand streams overlap, the effect is nonlinear. Industrial demand removes supply steadily and irreversibly. Monetary demand increases competition for what remains. Together, they compress availability from both ends. Supply cannot expand quickly enough to accommodate either, let alone both. This convergence is rare. Historically, commodities tend to be either industrial or monetary. Few operate effectively as both at scale. Silver does, and this duality amplifies its sensitivity to systemic change. The timing of this convergence matters. Industrial demand has been exceeding new supply for years. Monetary demand is emerging into an already constrained environment. There's no surplus buffer to absorb it. For markets, this means that traditional demand models understate risk. They assume substitution, elasticity, and inventory response that may not exist. They also assume that price alone can resolve imbalance. In reality, price is a signal, not a solution. As silver's monetary role strengthens, demand becomes less predictable and less price sensitive. This challenges conventional forecasting. It also increases the probability of rapid repricing. For business leaders and entrepreneurs, this shift carries implications beyond investment. Input costs, supply reliability, and currency exposure become linked. Assets that straddle industrial and monetary domains behave differently under stress. Silver's dual demand profile positions it at the center of this shift. It is no longer just a material input. It is becoming a measure of trust. When trust erodes, demand concentrates. And when demand concentrates in a market already constrained, price does not adjust gradually. It recalibrates to a new function and a new reality. Markets rarely move because of a single variable. Large repricing events occur when multiple systems weaken at the same time, removing the supports that once kept prices contained. Silver's current position cannot be understood in isolation. It sits at the intersection of several macroeconomic fractures that are developing simultaneously. The first fracture is monetary. Modern currencies are built on confidence rather than constraint. Over time, this design requires expansion. Money supply growth is not an exception. It is a structural feature. Each cycle introduces more units of currency into the system to sustain growth, service debt, and stabilize markets. Individually, these actions appear manageable. Collectively, they erode purchasing power. This erosion is gradual, which makes it easy to ignore. But it compounds. Over decades, currency loses its ability to store value reliably. When this becomes visible, capital seeks assets that cannot be expanded by policy. Historically, this shift benefits tangible stores of value. Silver occupies a unique position here. It is accessible, divisible, and historically trusted, yet far smaller than gold in market size. This makes it more sensitive to capital movement. Even modest reallocations exert pressure. The second fracture is in sovereign debt markets. Government bonds have long been considered the foundation of financial safety. They anchor portfolios, underpin pension systems, and serve as collateral across markets. This role depends on trust in long-term repayment and currency stability. When debt levels rise faster than economic output, that trust weakens. Rising yields, declining bond prices, and increasing refinancing risk signal strain. These signals do not imply immediate collapse, but they do indicate declining confidence. As confidence erodes, the assumption that bonds are risk-free is questioned. When traditional safe assets lose credibility, capital searches for alternatives. This search is not theoretical, it is practical. Investors look for assets that are not liabilities of another entity. Silver meets that requirement. The third fracture lies in real assets and commodities. Commodity markets reflect the physical economy. When supply constraints, geopolitical tension, and infrastructure stress converge, prices respond. Rising energy costs, tightening agricultural markets, and increased competition for resources feed inflation expectations. Inflation, in turn, undermines currency value. In such environments, monetary metals historically outperform. They do not produce income, but they preserve purchasing power. This preservation becomes attractive when real returns elsewhere decline. Equity markets add another layer. When stocks move sideways over extended periods while volatility increases, capital efficiency declines. Returns become harder to generate without increased risk. This encourages diversification into assets with different drivers. Silver benefits from this rotation. It does not depend on corporate earnings, fiscal stimulus, or credit expansion. Its value is derived from scarcity, utility, and trust. When traditional growth assets stall, these qualities gain relevance. The defining feature of the current environment is convergence. Currency debasement, debt stress, commodity inflation, and equity stagnation are not occurring separately. They are reinforcing one another. Each weakens confidence in paper-based claims and strengthens interest in tangible value. This convergence alters behavior. Risk is redefined. Volatility becomes acceptable if it offers protection against systemic loss. Stability is no longer measured by price smoothness, but by resilience to structural change. Silver's small market size magnifies these effects. Unlike large asset classes, it cannot absorb sudden interest without repricing. This is not a flaw, it is a characteristic. It makes silver responsive rather than resistant to macro shifts. The implication is not that silver rises indefinitely. It is that silver adjusts to reflect its role in a changing system. Price becomes a signal of stress elsewhere. Within this context, a move toward significantly higher pricing is not extreme. It is consistent with historical responses to similar conditions. When monetary credibility weakens and tangible assets are revalued, prices recalibrate to new baselines. For silver, that recalibration is amplified by decades of underadjustment. The longer an asset remains misaligned with macro reality, the sharper the correction when alignment occurs. This is why projections that appear aggressive in isolation become conservative when viewed systemically. They are not forecasts of enthusiasm. They are estimates of normalization. For business leaders, the lesson is not about prediction. It is about preparation. Structural shifts do not announce themselves clearly. They reveal themselves through convergence. When multiple systems point in the same direction, ignoring the signal becomes the greater risk. Silver's position at this convergence point is not accidental. It reflects